So I think that's some very important definition about you. So this is the first one that everybody knows in Silicon Valley. My question to you would be, so how did you end up becoming an angel and then seed investor and then your own fund? And so right now this is your third fund, right?
Yes.
This is raised over here.
Yeah. So my background is I'm actually a computer scientist, and I was born French. I'm now a US citizen, and I fell in the world of finance at the end of the 80s when we introduced some workstations and trading floors in a startup which I joined very early when I was still at school, and that got me without research thinking into the startup world. So I bypassed it. In France at the time, you were trying to get a good job in a big company. You were not doing startups. You were doing a startup if ever you were a failure. And so I went for that path, and after 5 years, the company was acquired by Reuters, which was the big player in the financial services market. I was the CTO at the time. And in 2000, I moved to the company to become what we call a traditional venture capitalist. And then in 2004, I saw the emergence of Web 2.0, those companies which were pretty big and very efficient and could test a number of things on a very small amount of money. And so what I decided to do in 2004 is to launch Zadać and to essentially become a full-time angel investor. So the first fund, Fund 1 as we call it, was essentially my money, and we invested in 20-something companies. And as the ultimate outsider, since I hadn't done a startup in the US, I wasn't from Harvard or Stanford, I managed to sort of be at the right time with a bit of money, a lot of support for those companies which were just getting off the ground. Then in 2007, I raised one of the first micro-VC funds, which was a $15 million sort of fund. And then last year, we announced our Fund 3, which actually we started investing 2 years ago, which was a $55 million fund, one of the largest micro-VC funds at the time.
So how did it feel that you were sort of not from the inside of Silicon Valley, right? There are a lot of people from Ukraine, from 17 countries, a lot of sort of new investors are coming to the Valley with plans to invest their money in companies. And you just mentioned that was not from Harvard. Did it feel like you were an outsider in the beginning, or how hard was it to get in the crowd and become one of them?
Well, I think the beauty of the companies is that as long as you're working incredibly hard and you're sort of trying to help support, do something which makes sense for the ecosystem, it's actually pretty easy. People won't put sort of roadblocks in front of you saying, oh, you can't do this, or you don't deserve to do that. Like we typically sort of see that in Europe. I'm not sure about Russia, but definitely France, UK, old Europe, stuff like that. I think that I was lucky in terms of timing, meaning that at the time, go back 2003, 2004, no one wanted to invest in Web 2 companies or the web or whatever, because it was still sort of, the post-Web 1 implosion that VCs were sort of leaking their content. And so I was just there with a little bit of money, big heart, trying to sort of really help companies. And even though I wasn't having the stretch of imagination, a big VC or an entrepreneur from that mature sort of sector, I was still someone who could help them with their financing strategy, with their pitch deck, with explaining the world of fundraising. Because if you go back at that time, there were just a handful of us sort of blogging about fundraising, and there were no angelists, and there was no sort of online resource about all this information about term sheets and everything. And so I was able to sort of be there, help them, give them a bit of money. And because of that, there was not this notion of, one of us, sort of go away. It was, hey, give us the money, give us the help, thank you.
So what is it now, almost 10 years after, right? Is it a bubble? What's happening with angel and seed funding?
So I think that by showing the sort of the way and being successful, the original sort of angels, the group of people were called the super angels, which was basically 10, 12 of us were doing a lot of those initial sort of investments, had all gone to raise their own sort of version of the micro VC fund, whether it's a a 10, 15, whether it's a 50, whether it's 150, a lot of us have become sort of institutional, and we've proven that we could build those new brands sort of under the nose of local friends on Sentinel Road, just a few miles away from here. And we could actually get into really sort of interesting companies. And I think we sort of made it cool to be angels as well, because there was this bizarre sort of development where some of us, or some of them, became sort of celebrities. That Kevin Rose, I think, is the first guy who sort of made it really cool to be a web celebrity and an angel, and that created a lot of inspiration, but also aspiration into the angel space. And so suddenly, anyone and everyone who had some money, who made money on that, started selling their shares. I said when they sold the company, or doing the secondary transaction, wanted to become an angel. And certainly, we've sort of seen this explosion of capital coming in at the seed stage between the new angels, the existing micro VCs, our friends, the VCs, who also wanted to play, and that's created sort of an environment where we've seen the volume of transactions at seed increase maybe 3x over the past 3 years. And I actually don't have the actual number, but that's what it's scales.
Yes.
The issue is, so a ton of seed investments. The issue is that at Series A, so the next level, the $3, $5, $7 million sort of Series A that is led by traditional VCs, that amount of capital, this number of potential deals a year, hasn't really moved at all over the past 3 years. And so when people sort of talk about the Series A crunch, it's not so much that there's less happening on the Series A, there's the funnel coming from seed being much, much larger, and therefore, on a percentage basis, less companies will be funded. That's what's happening.
So let's talk a little bit about the angel funding, because the entrepreneurs on the other side, we're talking about it, we know what it is, but let's go back a little bit and just talk about the notion of the angel funding.
Sure.
And so how much do you invest? How do you pick those companies? Another question would be, if you have, there are a lot of guys coming from Europe, from Soviet Union countries, Ukraine, a lot of them coming from Ukraine. And, I've seen them over the years, and definitely the quality has improved a lot. But still, the valley is not sort of accepting people from the outside of the valley. You have to be here, you have to be based here, you have to have your business. Nobody cares where you do development, right? But the founders sort of have to be local. So can you talk a little bit about all those things?
Sure. So let me just peel the onion a little bit. First and foremost, I'll actually go backwards. So first, location. So it's true that as long as you're local, meaning, most of your team, the management, marketing, sales, biz dev, so is here. And if your development team is actually in Ukraine, and funny enough, one of my companies, Tracad, is exactly organized that way, where our development is in Ukraine.
The
founders are actually the British. So there's a Ukrainian guy who is our CTO, there is a British guy who's our CEO, and the company has moved from London to New York and just opened an office in Silicon Valley. And they're sort of a US company, and they flipped from a UK company to a US company, so they're local, and just so happens that they're scattered, across the world, because that's what their market is. And so as long as you pitch yourself as a local company, it doesn't really matter, the funny accent that you might have, like mine, or where your development resources might be. To be honest, having great developers in Ukraine is actually more of an advantage today, because it's so hard to recruit people here.
But how do you do due diligence on the entrepreneur? So I came from nowhere. Okay, to register a company is a no-brainer, right? I come to you, I pitch the company. Okay, you like the idea, you like me, but then you have LPs and you have your own rules, right? So everything is here for a while.
Yes, it's basically what I wanted to explain is that as long as you're local, you will be treated like any other Silicon Valley entrepreneur. The challenge is to actually get here and create your local network, because the one thing that we always operate on here in terms of how to filter opportunities, and we get thousands upon thousands of emails and intros, every year, is figure out who actually made the connection, from the entrepreneur standpoint. So if you look back at 9 years almost of investments and 140 deals, I've actually never invested in something that cold called me. So someone just emailed, an entrepreneur sending a plan saying, hey, this is who I am, this is what I do. It's not that we don't want to consider them. It's that we look at the funnel, sorted by, or in reverse priority, meaning the top is basically entrepreneurs we've worked with, investors we've invested with, and typically those are the deals that we end up working with. Then there is, investment. You have referred to me a few investments coming from Russia or Ukraine, because I know you have also looked at them. But, because they're from Ukraine or Russia, typically we don't invest there, so they have to be sort of either exceptional. And, I can think of a deal called Farmland, which is based in Croatia, and we actually invested in the Croatian company, because what they do is basically, sort of once in a lifetime kind of opportunity, and we said, okay, well, it's
so what is so incredible about them?
Those guys are building a SaaS back office platform for the farming world, and they're experts in farming and software development, and it's pretty unique. Yeah, it's massive. It's a sort of multi-billion, it's tens of billions of dollars, which is a very fragmented market where a ton of the opportunities actually in Croatia, in Ukraine, in Russia, because this is where all the European super farms are. And so we decided that this was sort of big enough as an opportunity that we essentially invested in this company, which is in a place where I've never been and I likely will never go in my life. And so the way to do that...
How do you work with them?
Skype. And they come here, every couple of months. But the point is, before we actually invested in those guys, they actually did, the family startups incubator, and they were part of CCAM. And so, to be candid, if they hadn't spent time with my friends at CCAM and family startups, I don't think that we could have gotten over the hurdle of investing in a market that we don't know much about, farming, and in Croatia. So you have to really sort of understand that you can't sort of come from Ukraine, land in San Francisco and try to raise money. It takes time to actually build this network that will essentially help you get in front of investors. So the referral, the network is really important. In terms of the numbers, so typical seed round these days in the Valley, and it's really different from Valley and even other parts of the US and definitely Europe. I barely see anything below the $1 million sort of range. Most of what we do, because with our fund, we'll do $500,000 sort of minimum general investment. The most typical sort of seed round will be between 1.2 and 2 million. Some other sort of seed rounds are smaller, and I see people investing, $500K, $250K. And what really matters more than the actual amount is the runway that round is going to give you. And we always recommend getting anywhere from 18 to 24 months. That's sort of the bare minimum. Why? Because you're going to get this seed investment, you're going to start building your team, you're going to have to get your product, either product to market or have the product start scaling, to prove that you're worthy of a Series A. And typically, by the time you're trying to raise your $3 to $7 million Series A, you need to have proven that you have a credible and scalable user acquisition sort of mechanic that, depending on the type of company that you're building, you have, sort of started proving the revenue side, or you have, massive traction and a lot of organic retention, and you have proven that you could build a really big company, because that's where a lot of those startups sort of fail today, and that's what makes them fail at the Series A, is that, you've proven that you could do all this, but you're basically a few $1 million kind of market opportunity, which means that you are not, it doesn't make sense for you to raise VC financing, because you will never sort of provide the returns that those guys sort of need. And so, in this environment, in those sort of 18 to 24 months, is what it takes to actually get above this Series A hurdle. Sometimes you will need to, and for us to sort of make a positive decision, we need to see, the core sort of members of the team being on board. We need to see sort of a prototype already in the hands of some users, and we need to sort of figure out what you have already proven in terms of user acquisition, in terms of retention, and sort of a few ideas around monetization. Which means that you need actually to have been working on this for 6 months, 9 months, a year. And so how do you fund that? Well, you fund that either on your sort of savings, or you've done a friends and family round, which is sort of a small round, sometimes involving friends, family, angels, and fools, yeah. Or you have done an incubator, which will give you support and some financing. And so this sort of initial round will be a few tens of thousands of dollars or a couple $100,000, which typically we won't get involved in, but that will sort of get you off the ground and will allow you to run for a year, maybe on a very even basis.
Let's talk about incubators a little bit. So on the one hand, it's really a cool idea, right? There's so many of them, and especially with Y Incubator, on the one hand, it's a good source of deals. On the other hand, aren't the valuations too high in the valley, especially for the companies coming out of the Y Incubator? Basically, everybody wants these companies with the valuation so high that what US major student investors feel, like, when they say 5, 10, 15, 20.
Yeah. Well, so, as you said, not all incubators are pretty easy, right? And the challenge we have, because going back, I've seen the whole story, so I've seen Y Combinator sort of getting off the ground in Boston, and they were sort of, really the first ones. And at the time, it wasn't clear to me that the support they were delivering was worth, 6 or 7% of equity that they're getting. And then I started sort of seeing the quality of the companies that they were bringing to us and our investors really sort of increase and become really sort of pretty interesting. And then, like everything in a supply-demand, market, valuations sort of got pretty crazy. But at the end of the day, nothing forces us to invest, and we decide whether the opportunity is worth, X million dollars or tens of millions of dollars or whatever. And so what we've seen is, over the past few years, is we've actually invested in a fair amount of Y Combinator dealers. And, jury's still out as to whether those were sort of smart investments or not. We've also been very close to Techstars, so I'm a venture of Techstars, and we've been working with them very closely in Boulder and in New York.
Do you invest in YC companies?
Yeah. We've done 5 or 6 over the past few years. We've done, similar amount of Techstars companies. We've worked closely with the Angel Pad guys as well, which is sort of a smaller incubator that essentially is a bunch of ex-Google people working very closely with companies. We like those guys a lot. David McClure, one of the founders, is a great friend of mine. So we sort of look at the output of the Founding Startups program, CCAM, which is the European incubator, very close to as well. So there's and we don't have anything against the other, 99 incubators, just that we can't attend demo day or everything and so forth. Now we start seeing people who have, specialties, like Lemnos Labs is a hardware incubator, so we found that because we're interested. The Alchemist program just was announced. It's a B2B focus of incubator, so we'll take a look at that as well. And for us, we think that any credible group of people and mentors who support companies will definitely deliver value and will sort of pay attention. The question is, will we pay a greater attention or will we pay some attention? Because we don't invest in incubators. We actually we had the opportunity to invest in YC, Techstars, CCAM, and basically passed everything because we want to be sort of Switzerland. And we'll look at those companies, but we don't want to sort of get involved in the funds themselves. And to be honest, not investing in YC was foolish because those guys are going to make a ton of money. from an investment perspective, it was not the right choice, but from a strategic positioning of SoftTech, it was the right choice.
Sorry, if you want to get some water, unfortunately, we not bring water inside, so you just step out.
Oh, okay. No worries, that's fine. And so, I think that especially for sort of foreign founders who might not have all the resources and the connections in the body, I think that trying to give a shot to being in one of the good or great incubators is actually a pretty good tactic, because it sort of gets you in, puts you in the network, and for 3-4 months you can actually do a, sort of a crash course at how to deal with investors in the valley, get the connections, get the stamp of approval of the incubator. And if you're getting YC, Techstars, AngelPad, that's actually pretty good. It's pretty meaningful.
So let's talk about the process. How do you pick the deal? What ignites you? What makes you interested? How do you go through the due diligence and end up investing? Let's talk about the whole process.
Okay. So the deal gets in the funnel through that trusted referral we talked about. So someone we know, sends us an email typically saying, "Hey, I met this entrepreneur. This is why I think it's sort of interesting. This is why I liked it, and this is why I think you might too." And we look at that, and depending on how close we are with that person, if it's like one of our entrepreneurs who knows exactly how we think about deals because they're in the portfolio, then we'll typically take the deal into a meeting, except if there is potential overlap or competition in the portfolio. So we pay a great deal of attention, always leaving a lot of white space between our companies. And so if something is kind of too close for comfort, we don't take the meeting. So I would say less than 20% of the opportunities that are referred to us come in the first meeting. So the filter is actually pretty steep there. So the first meeting is sort of an exploration, and it's one of us. So there's 3 of us on the investment side, my partner Charles, Steph, and myself. And we tend to have, sort of specialties. So I'm more the B2B SaaS guy. Steph is going to look at a lot of the next generation commerce and marketplaces, and Charles is more sort of mobile gaming kind of guy. So depending on where the company is situated across those sectors, one of us will do the first meeting. And so it's an hour meeting, and we'll go through a pitch deck, which is a 10, 12, 15 page PowerPoint that goes through all the aspects of the deal. So presenting the team, the opportunity, the market they go after, in no specific order, the product, the competition ecosystem that they're working in, how much they want to raise and what for, what sort of validation they've already made. So in terms of user acquisition, in terms of retention, in terms of costs of acquisition of a user, a few ideas around monetization, and what they want to do over the next 18 to 24 months to actually prove themselves as a serious opportunity. So put everything in the mixer. We go through that. We ask a lot of questions. We tend to be pretty straightforward. So if ever I know that this isn't going to be for us, I'm just going to say it like it is.
So it's a
and explain why.
Yeah. So it's more of a feeling.
Well, it's after seeing, someone asked me once, how many pitches I've seen, how many companies my guess is like 15,000, but I actually don't know because I never sort of kept track. You just develop this sort of initial feel for, hey, this is something which is really sort of the kind of thing that could be, for us, or it's not for us. So you try and get that gut feel going during the meeting, and then, we as a team meet on Mondays and Thursdays. And so we go through the funnel and we say, well, this is the one I've met. This is why I think it's interesting. This is why I think you guys should take a look. And we sort of discuss. And then someone else in the team, either, 2 or 1 person, 2% or 1% is going to sort of take the next meeting, and then we'll bring together our thoughts and say, It's kind of interesting, but I don't think it's big enough. A lot of those deals go that way.
How big should it be?
Big enough is, it's kind of a random, artificial sort of hurdle, which is, I don't see this company going to $100 million in revenue. The sort of $100 million in revenue means sort of scale. And it's so hard to get to $100 million in revenue.
Right.
Like, we don't have that many companies which are above, $100 million in revenues.
But at least the potential.
But once, the way you think about it is, if we believe that you can actually get there, and it might take 5 years, right? Some actually go there much faster. Then you're a real company, because essentially, $100 million in revenues with good growth is basically a public company. So it's sort of the same way of saying, well, we think that this company can be a public company, right? And so we sort of try this is really hard at the beginning to figure out whether something is going to be a $100 million company, but we have to believe that it's actually feasible. So we sort of look at that. We look at the product. Is it differentiated? Does the product have enough of a footprint? Or if it's a marketplace, do we believe that the marketplace can actually yield, billions of dollars in transactions, which will yield, millions of dollars in revenue? And we try and assess what it would take to basically get there. And if we feel that it is actually worth a shot, then we're going to spend. We move the deal into another bucket, and then we're going to start a real sort of due diligence, talking to experts in the space, if they have, clients, talking to their clients, doing reference checks about the people involved in the company.
How much time does it take you? What's the period for entrepreneur to wait for your answer?
So it takes, a week or two to get a meeting, with us, because typically, we're pretty busy.
Right.
But, sometimes we can go faster. Then, once we've had the first meeting, the second meeting should happen within, a week. Then if we say, well, let's continue, it's going to take about 5 to 10 days to do a due diligence, sort of reference
quick.
checks. So yeah, we
say in a month or month and a half, you
we should be able to sort of make deals which are really sort of interesting and we really like will typically move quickly. So we'll try and grab something which is really interesting to us within a couple of weeks, I would say. Sometimes we've moved, in 2 days. It's kind of silly, but I remember sort of, meeting a deal on Friday, sort of talking to my partners over the weekend, doing reference checks on a Sunday, and then making an offer on Monday. But that's sort of silly.
So where is this deal now?
We'll see.
So it's still not clear.
Well, sometimes it just takes a long time for something to get there. Let's put it this way: we're still pretty happy to have made the investment.
Okay.
Others, Farm-Around, the Croatian deal, it took us like 2 months to get comfortable with, the deal, the opportunity, the location, how we would actually work with the team remotely, with Mattia, the CEO. We were lucky to have a great co-investor. We're friends from NextView, and so we actually compared notes with those guys saying, well, this is where we're excited, this is where we're excited, we're both excited, let's just do it. And so it took more time because it was not as obvious for us that deal was, a sort of something that we should go do because of the location and the market. But we still did it.
But what are you looking for? Are you looking for people, for ideas, for...
Yep.
So or is it all these components? And my specific question would be, mostly these are people, right? I mean, if you can execute, I guess, we'll talk about it. But so talking about people, what is it that makes you excited?
So we actually look for 3 things.
Right.
People, product. We look at 3 things. The people side, the founders, obviously the most important. The product. So what is it that they want to go build? How differentiated is it? We've seen after Instagram was acquired for like $1 billion, we've seen 10, 15, photo sharing, products, mobile applications, whatever. And we were like, dude, seriously, do something else. And yes, there might be another $1 billion acquisition in the photo sharing space and so on and so forth. But please, right? And then, this market opportunity aspect, the $100 million, revenue company. And so we spent a lot of time understanding the founders, but great, like a superb founding team without the product side will be hard for us to execute on, right?
Sure.
And likewise, the way I sort of think about this investment decision is it's not sort of binary instead of gates, it's a scale. And every component about the deal is sort of a big weight, small weight, a bit overweight, and so on and so forth. And as you add all those data points that you learn about the deal, at some point the scale might tilt and you make, a positive investment decision. It's just not one thing that you go after. Like some of my friends will say, we just believe in the market, and that's what Sequoia does, for example. They just go after existing huge market, or they create huge markets, and that's what matters. Other people will say, I just invest in the founders. I don't give a playing crap about what they do. If they're great, I will fund them. And we're just sort of different. Obviously, if it is a founder we've already backed and has already made money for us, we'll say, okay, fine, we'll invest in you and we'll sort of give you a pass on the product. But even that is hard. We've had a couple of founders who we made a lot of money with, and then they came back with opportunities they were working on, and we just couldn't get there because we didn't like those things. And actually we're right, because both failed. So it's just this notion of having a very high bar, saying no 99.5 or 99.7% of the time. So we always say no. Like I always say no to you, and I feel bad about it because I would love to say yes, but typically, we say no to most people. And even if we only say yes a few times, we're still wrong at least 20-30% of the time.
Yeah, well, it's hard to invest in Russian and Ukrainian companies, definitely. Yeah.
Let me just grab some water,
Sure.
because I'm gonna get.
Oui.
Sorry. Okay. Sorry.
So what makes you excited about the team, about the people? What are you looking for in the people?
It's typically the right mix of skill set based on the opportunity they're going after. So let's say that they're trying to build a strong sort of B2C service or application. The three components we are looking at are a strong tech co-founder. So, someone who has built, a soup to nuts back-end, front-end, mobile app, whatever they're doing, but someone who's demonstrated that he could actually deliver on the goods on the technical side. Someone on the design side. So typically, user experience, user interface is the root of organic sort of retention and growth. Mm-hmm. So you want to sort of have that on the team. And then someone who's really sort of good at distribution. So figuring out, sales. Pockets of users. Well, it's either sales, biz dev if it's B2B, mm-hmm. It's distribution if it's a mobile app, it's distribution if it's a pure B2C sort of website. So people will be able to build, please the users, and figure out the pockets of users that they can actually easily sort of access, use those for initial referrals, have really good retention, so they don't have to require users, and then sort of get to building either a big client list or huge traction of through users. And so we try to get the skill set and the experience in the team. We need to find them inspiring, have a lot of empathy, because it's really important for a founder to excite people that he or she meets, whether it's investors, potential employees, users, partners, and so on and so forth. And we need to sort of see this what I call the walk through walls attitude, where we know that even if there are roadblocks, those guys will just go through them. But at the same time, they have the smarts to sort of figure out how to sometimes go around the wall as opposed to trying to walk through it. And
how flexible should they be?
It's kind of interesting because they need to be, stubborn enough to be able to go through all the issues they're going to face as startup founders. At the same time, you need to get a feel that they will actually listen to you. And there's always a discussion as to whether investors are really sort of helpful, useful, and so on and so forth. And you could argue that, you shouldn't listen to investors because most of them don't have a clue. At the same time, we sort of think we know a few things. And so if ever we have founders who basically completely ignore what we say, it's a problem for us. So we try to sort of, not too flexible, because you don't want people to just say, oh, I'll do whatever you tell me to, because that's really bad. But you want to have a minimum flexibility there. And also there is the personal sort of aspect, a personal connection, because we're going to spend a lot of time with these people. We're going to spend a lot of time with these people over, a number of years. And you'd
mostly
better
talking about problems.
Yeah, and you want to be able to see that you're going to build a rapport that will allow you to actually go through ups and downs, because the last thing that we are is, entrepreneurs' best friends. We're pretty pushy. We're pretty demanding. We'll sort of push them hard. Like last week, we had a board meeting with the company, which absolutely killed it in 2012. They just they nailed it. They did extremely well. Sales, revenues, scaled the company, potential, everything. Awesome. So super excited. We said, you guys sort of nailed it in 2012. Great. But you're basically sheepish in your 2013 plan because you're only planning to grow 50%. And at this point in time, you should, try and figure out how you can grow 200%, to really accelerate the growth. And they were like disappointed because they had done well.
So much effort.
Yeah, they had done well in 2012, and it's true, they had. But they were not aggressive enough based on what they had proven they could deliver on. And if they only do 50% growth, which is, for a company at scale, awesome, but for a company which is where they are is just not enough, they wouldn't sort of continue being as interesting. And so figuring out how you can really control them on one side but just kick their ass at the same time is part of the trick. And so you want to be certain that the people on the other side of the table will be able to sort of take that in and react properly. So we try and find, pretty unique teams. And like I said, more often than not, it's not true. More often than not, we actually succeed. But we still sort of go wrong and end up backing, the wrong founders or the wrong startups.
Oh, that's normal.
Yeah.
But what happens when you lose interest? So say you're disappointed. You think they will not deliver. What happens then?
So we'll work hard to try and because nothing works out as planned. Nothing.
Right.
It's very rare that. Mint and Fitbit are sort of a couple of companies that basically have done nothing but what they said they would do from day one. It took a few years for Mint to sort of get to where they ended up sort of exiting. Now Fitbit is just crushing it. But they have fundamentally not changed what they said of doing, 5 or 6 years ago, and so on and so forth. So you expect that there's going to be a lot of issues around, around initial execution, and the ramp is not going to grow fast enough, and blah, blah, blah. The issue is when it just doesn't work at all. Everything you try, all the tricks in the books, user acquisition techniques, marketing, whatever, doesn't get you the users, people sort of don't engage, they don't come back or whatever. And after 6 to 12 months of trying, and it's not like go ahead and disappear for 12 months and come back. It's, we meet every 2 weeks, sometimes every week, sometimes every, we do board meetings every month and so on and so forth. And so if it doesn't take off, it doesn't work, then we sort of adjust. But after 6 months or 12 months, if you sort of look back and see that it's not working, you just say, hey, we've tried everything we knew could work. Either we need to find, other people to join the company to help us with other tricks in the books, or we just were wrong in our assumptions about this being actually a viable sort of product, company, opportunity, and so on and so forth. And at that time, we'll have, depending on how much cash is left in the company, we'll say, hey, is there anything else that you guys would want to do with that team that you've built and you know, you now have been working together as a team for like 6, 9, 12 months. It's actually something valuable. And if they say, well, yes, you know, we have this other project we're very passionate about, and sort of the proverbial pivot that, you know, Fab.com is one of the most famous, where they were sort of this, they were this sort of Facebook for gay men that turned into this massive success of sort of an online version of IKEA. So it's everyday design made available through a unique sort of e-commerce experience. And so Jason and Bradford, after 6 months, said, look, we know we can be successful, but we won't create, you know, a $1 billion company with Fab.com, the original one. But we're passionate about this thing, which we think can be a multi-billion dollar company. We can either return the rest of the cash or go do that. And so, you know, they went.
Okay, go try.
Yeah, go try. And so if you have built, you know, faith in the founders and realize that the opportunity is just not working, then it's fine. You know, they'll go do something else, because that's at the time you're betting on the founders. But if you're not super impressed, or the founders haven't been sort of quick to react or whatever, which is often the case, they try breaking through the wall for, you know, 3 months or 6 months too long, then, you know, you just soft land the company. And in this environment, trying to find a buyer for an early stage startup with just a few engineers is just brutally difficult. And typically we'll
just kill the company.
Well, we don't kill the company,
Dies.
but, you know, it just dies. Right. And so
I actually want to switch a little bit to the trends in like 2 minutes. So can we just quickly talk about the sort of most disappointing experience that you had? And you may not need, you know, to name the company. And then maybe one of the most sort of the ones that you remember is the brightest and most interesting experiences that you had.
You know, it's kind of interesting because in our job, we always sort of think about, you know, tomorrow's problems. So that when you have a portfolio as large as ours, there's always something which isn't working, and so you focus on sort of fixing those issues. I think that you know, Wildfire Interactive, which was a social media marketing company that I've been working with for about 3 years before they were acquired by Google for $500 million, close to $500 million, was actually a great experience, because I just loved the founders. That husband-wife founding team was just exceptional.
You just specialize in the husband and wife team.
Yeah, we love them. You know, Eventbrite, we have Wildfire, we recently invested in Ubly. We have no problem with husband and wife teams. And so those guys had seen the social media marketing opportunity, so how to leverage social media platforms on behalf of brands very early on. And by the time we invested, which was at that, you know, a Series A, because they were making so much revenue at the time that they barely needed the capital, so we had to put together a real Series A to invest in those guys. And they just nailed the execution. They grew the team, they grew the opportunity. They were just absolutely killing it. And every time I was sort of meeting them, it was sort of good news all around. And
that's wonderful.
And it was almost sort of this, and that was sort of my initial reaction when Victoria, the CEO, sent me that text saying that she had signed the deal to sell to Google. I was like, what the fuck are we saying so early? And then I was like, how much was it again? And then she says, okay, good, what? But still too early. So that was
too well hip, yeah.
You know, it's a lot of money, but I think they could have been a public company, but you know, at the same time, I understand why they decided to sell early in a market which was consolidating so quickly. Right. I think in terms of disappointments, there's a lot of so there's two types of disappointments. One is you really sort of like the founders, you like the opportunity, and it just doesn't work, and you're sort of you're sort of disappointed. And sometimes the worst disappointments to me are the companies which had an opportunity, but where the execution, so the shit just didn't work, where founders just screwed up the initial execution. They couldn't build a product, and they couldn't really sort of demonstrate that the opportunity they were after was real or not. That's typically pretty disappointing. The other sort of huge disappointment is the company sort of starting to grow, raise a lot of money, get the hype, and so on and so forth, and then it sort of goes on the cliff and then drops off. I had an early mover in social media marketing way back when, 2007, get to close to $20 million in revenue and then go back to zero. That really, really hurts. And so those are sort of disappointing experiences. But at the end of the day, we're in the business of taking a lot of risk in terms of the investments that we make. Figure out, what is the appropriate exposure that we need to take in terms of amounts of money that we invest. Whether we should participate in the next round and so on and so forth. To increase the exposure or limit the exposure. And we make a bunch of mistakes. The question is, can we still sort of yield a very successful outcome for our own investors or own LPs with the companies that we sort of called right and made a lot of investments into. So Fab, for example, we've invested 4 times in the company, and we have close to $1 million in Fab, and we're thrilled to be involved in the company. And it's going to take another few years to really sort of get them to $1 billion in GMV, because in e-commerce you're no one before that. But it's been certainly very thrilling to be involved.
So we don't have that much time left, right? So let's talk quickly about the trends, what's happening in the Valley, because for entrepreneurs from Ukraine and the former Soviet Union countries, it's very interesting what's happening here, what's happening in the Valley.
So in terms of trends, I think that so B2C has been extremely, so business to consumer, whether it's mobile apps or web services, have been red hot for 3-4 years now. And I think that we're in a bit of a cooling off period because 2 things. One is there's been so many B2C companies being funded that a lot of people now want to step back and see how well they do in terms of raising Series A's and Series B's in their portfolio. I think that the disappointing performance of Facebook, Groupon, Zynga has definitely cooled off a lot of the interest in growth stages of those companies. So there is a bit of a cooling off period there. B2B on the other side is sort of back in force. So things which are typically perceived as sort of more boring, focused on the enterprise, things like Farm Around is sort of a B2B investment. We've done actually a lot of B2B things last year. We're pretty excited about a number of them. We'll see how they do. The issue is that they're always sort of slower to scale, harder to prove. It's, you always, and you sort of look at revenue in a very sort of fixated way. So you look at your monthly recurring revenue if you're a SaaS company, and we bring them in the portfolio when they have like 20K, and we need to get them to sort of 100, 150, 200, 250K in MR so that they can actually break through this Series A hurdle. But those are real companies because you'll get to millions of dollars in revenue on your seed financing. I think that hardware is actually back.
Really?
There's been, Fitbit, Nest, a few other companies have proven that you could build.
It's a little bit different type of
this is
hardware, because I don't think that. Okay.
Well, those are services which are there is a piece of hardware that the customer is going to buy, install, wear. In the case of a Fitbit, it's going to be connected. You're going to be interacting with it with your device. Recently, I've seen a company called Luckytron, which is sort of doing that with a door bolt, which I think is sort of fascinating. And so not every device, not every piece of commodity hardware can be turned into a sort of an Internet of Things kind of thing.
but there are definitely interesting companies to be built there. And having spent 4 years with Fitbit, I can see sort of let's put it this way, when it works, it grows huge so fast. So provided that you find, the right device and the right, product to put together, it's really exciting.
What about gaming?
Yeah, tough, really tough because of Zynga. It's not so much that people stop playing, they continue. The issue is more sort of what happens with the company once it's scaled, knowing that Zynga has lost 85% of its public, capitalization sort of value. And if you look at the other companies which are doing well, it's not clear to me that they can actually go public. And so they're sort of there, making a lot of money, being successful, but without any exit.
Any questions you have? We have 3 more minutes, right? 2 more minutes. All right, I guess we're on time. Yes.
Yeah. Hey. Yes.
Is it possible for the same thing happening? I mean, I understand that they speak English, you speak English, it's kind of like common mentality. But for example,
Well, Jeff speaks French as well.
CS country, and is it possible for you to do the same trick with CS? For example, if founders want to move to US and still have team in Ukraine, but the mentality is a little bit different, so like they need to adapt to US, to market. So is it possible at all